So we're now going to continue our lecture talking about the income statement and then also a side aspect of dividends. Now, revenues, expenses, and dividends. Revenues minus expenses give us something that's called net income. The profits in the company are ultimately given or claimed by the shareholders of a company. So companies, of course, the goal is to make money, make a profit, and companies make profits by bringing in revenues and then having expenses to help make those revenues, with the difference being what we call net income. The revenues would be either sale of products or services to customers. So, for example, Target it's a merchandising company and they sell goods to individuals. Service companies would be that of an attorney or a CPA firm or a physician, where they receive revenues by providing services to their customers. Expenses are incurred because there are costs in order to sell those products or services, such as salaries, rent, insurance, costs that are incurred in order for the company to make revenues. An important item for you to know: dividends are the monies that get distributed back to the shareholders because the company made profits. Dividends are a part of the stockholders' equity section. They are not an expense of the business. So basically, when the shareholders receive a piece of the profits, that is a return back to the shareholders for investing in the company. That would not be an expense on the income statement. Let's kind of go through an example of this Eagle Golf Academy, and let's just take some hypothetical scenarios to see how we would provide an income statement. So in its first month, Eagle has $3,500 in revenues from giving lessons. Again, that's a service industry. The expenses include salaries of $1,000, supplies of $500, and miscellaneous expenses of $750. So what we would do here, I'm showing you an income statement from Eagle Golf Academy. We show revenues of $3,500, and then we list the expenses together. The salaries of $1,000, the supplies of $500, and then the miscellaneous of $750 give us total expenses of $2,250. Then, as you see from there, our revenues of $3,500 minus our expenses of $2,250 end up giving us the net income of $1,250. This is an income statement. So what we've gone through are bringing together some concepts of resources and claims to resources. And basically what we are talking about there would be assets or resources, and then the claims to resources we talked about being amounts owed would be liabilities, like bank loans, and then stockholders' investments into a company would be stockholders' equity. These items, the assets, the liabilities, and the stockholders' equity, relate to what we call the accounting equation. Another way of looking at that, those measurements are part of what we would call the balance sheet. Now those distributions to stockholders, or those dividends, will also be part of the balance sheet as it relates to stockholders' equity. The other measurements of revenues and expenses, the sales of receiving services or selling products, are the revenues, and then the cost incurred in providing those revenues, expenses. Those two items relate to the income statement. Those specific categories provide us with the information in order to accurately create the net income or the income statement. So as you see here, we've got various activities related to this company, the golf school, and we measure those various activities based on, are they resources? Are they claims to those resources? Are they bringing in revenues? Are they expenses or costs to make those revenues? Or are we possibly paying back a portion of those profits to the shareholders, which would be dividends? So we're going to have some of these key points throughout the course. The measurement role of accounting is to create a record of the activities of a company. To make this possible, companies have to maintain clear and accurate records of its assets, of its liabilities, of its stockholders' equity, of any revenues the company brings in, of the expenses, and lastly, of the dividends. So they've got to keep accurate records of this. When there are business activities that are being performed, it's important that companies keep documentation and substantiate exactly every transaction that happens in a business. Let's do a little checking to see if you're picking up on these concepts. The resources of a company are referred to as A, liabilities, B, revenues, C, assets, or D, expenses. I hope you get this one. Assets. Those are the resources of the company that help future operations of a company. Items that are in assets include cash, inventory, supplies, buildings, and equipment. Here's another one. The amounts recorded when the company sells products or provides services to customers are referred to as A, liabilities, B, revenues, C, assets, or D, expenses. Remember, we talked about there are two ways in which companies bring in revenues: by selling products or providing services. Here's another exercise to help you master these concepts. On the left-hand side, we see various names: liabilities, revenues, dividends, stockholders' equity, assets, and expenses, different account types. Over on the right-hand side, we have an example of each. So, for example, if we start land owned by a company, what type of an account is that description? Land owned by a company? That would be an asset. Remember, it's a resource that will provide future benefits for a company. Now let's look at the next one, amounts owed to a bank. Those would be liabilities. Remember, there are two types of claims. Claims for people that we owe money to, and then claims that the stockholders have to the company. Next, common stock issued to investors. That would be part of the Stockholders Equity section. What are the payments we make to stockholders because we're giving them a return on the money a company's making? Remember, those are dividends. Once again, dividends are not part of the income statement. They're ultimately a manner in which we reduce the stockholders' equity section. Next, cleaning services provided to customers would be revenues. And then last, workers' salaries for the current period. You got it. It's an expense. Okay, so here we've got an example we're going to go through. This is in your book. If you look at exercise 110, you can follow along here. So basically, what we're going to do here is look at the Fighting Okra Cooking Services. They report the following revenues and expenses. So as you see here, Fighting Okra has service revenues of $75,000. Then they have a postage expense of $1,500, legal fees expense of $2,400, rent expense of $10,600, salaries expense of $24,000, and supplies expense of $14,500. Now it's giving us some other information, but initially, to prepare an income statement, let's just look at those 6 accounts in the middle of the screen here. We're going to create an income statement here. As you see, the one key item in preparing an income statement is the name of the company, and we want to show it as an income statement. Now, one thing I didn't put in here, it's always important to put the date. So I didn't do that, but you get the drift. You want a date in here. We start with revenues. You see service revenues of $75,000. And then from there, we categorize all of our expenses. We total those expenses. The salary expense of $24,000, supplies expense of $14,500, rent expense of $10,600, legal fees expense of $2,400, and postage expense of $1,500 give us a total of $53,000 of expenses. The difference of the service revenues minus the expenses give us our net income of $22,000. Now, the second part of this exercise asks us to prepare a stockholders' equity section. So I've laid out for you how a stockholders' equity section is created. It gave us some information that said, in addition, the balance of common stock at the beginning of the year was $200,000 and the balance of retained earnings was $32,000. During the year, the company issued some additional shares of common stock for $25,000 and paid dividends of $10,000. So we're going to begin this stockholders' equity section by putting in the information provided for us. The beginning balance of common stocks, $200,000. The beginning balance of retained earnings is $32,000. So basically, this company has been in existence prior to this year. So they have common stock, stockholders that have invested in this company of $200,000, and their retained earnings, which would be their net income minus any dividends that have been paid out are $32,000. So the combination of the common stock and the retained earnings equal the stockholders' equity section, or $232,000. The next part is to add any common stock that was issued in this period. Well, the information told us that $25,000 was added, so we show that increase of common stock issued in this period, $25,000, and we carry that over to the stockholders' equity section, as you see there. Next, the net income that we show in this current period, what we just finished preparing, the income statement of $22,000, is going to be placed in this section. We add the net income for the period of $22,000. We're going to add that in the retained earnings section. Then the dividends that were paid out are $10,000. Now remember, we're going to subtract dividends because it's going to reduce the retained earnings section. Net income increases the retained earnings section, but dividends are going to decrease the retained earnings section. So we put in that $10,000 of dividends paid. Therefore, we end up with an ending balance of just bringing down the figures. The common stock now has $225,000. Our retained earnings section contains $44,000. And stockholders' equity is a combination of the common stock and the retained earnings, or stockholders' equity. We end the period with $269,000. I'm going to just touch on business structures just for a second in this beginning chapter. There are primarily three types of structures that businesses are set up with. The easiest form is called a sole proprietorship. It's the most simple way to just start a business. It's one person that decides, I'm going into business, and they just begin. Sole proprietors there are more sole proprietors in numbers in the United States than any other form of business. The next would be partnerships, where a business is owned by two or more individuals. Then last, corporations. Now, corporations make up the largest amount of income that comes into the United States, but those are businesses that are separate from its owners. A big piece of corporations relate to the limited liability of their shareholders. We'll talk more about various types of business entities later, but I just wanted to cover in a nutshell those three primary forms. Next, in this chapter, we're going to talk about business activities. Businesses generally perform three different types of activities: financing, investing, and operating activities. Now, financing activities are activities or transactions the company has with its investors and with its creditors. So any type of engagement with investors or with creditors, or paying back investors or creditors, relate to financing activities. Investing activities are those transactions that involve the purchase and sale of resources that will provide a benefit for this year and beyond. Then lastly, we have operating activities. Those are transactions that involve the normal operations of the company, why the company is in existence to begin with. So when we talk about financing activities, the two primary activities deal with issuing stock and taking out loans, credit types of transactions. Investing activities are pursuing resources that are going to benefit the company for greater than a year. Heavy-duty equipment, property, plant, and equipment, land, those are investing activities. And then the normal operating activities would be the revenues created for a company and the various costs related to making those revenues. So insurance would be a cost in having a business. Inventory in the warehouse, those are the goods that are being sold in order to create revenues. And salaries would be an operating activity. So we're going to go through exercise 1.1 in the back of the chapter just so you can gain some understanding of the various types of activities. So you see here a list of transactions and a list of business activities. We're going to match the transactions with the business activities by indicating the letter that corresponds to that activity. So as you see here, borrow from a bank. Well, when we borrow from a bank, we are financing. We are creating manners in which we can finance the business. Providing services to customers. Services to customers would be creating revenues, which is in the normal course of the business, which would be operating activities. If we issue common stock to investors, what are we doing? We're financing. We're creating sources of monies to finance the business. If we purchase land, that's investing in the future. Pay rent for the current period, operating. That's an operating activity that is the normal course of business, why this company is in existence. We pay dividends to stockholders. Well, think about that. If we're paying dividends to stockholders, we're dealing with the financing activities. We're giving them a return on their investment. That's the finance aspect. If we purchase a building, we are investing. That building is going to benefit us for more than the current period. So it's really helpful to go through these various transactions so you can gain an understanding of the various activities and the transactions and to be able to match them to one another. So transactions related to the primary business activities of a company, such as selling goods and services to customers, are referred to as financing activities, investing activities, or operating activities. Operating activities would be the right answer. Transactions of a company that include the purchase and sale of long-term assets are referred to as financing activities, investing activities, or operating activities. That would be the investing activities. So our next step here is going to be talking about how financial accounting information gets relayed through financial statements. Ultimately, that's our purpose, is we communicate information to external users, and we do that through our financial statements. So we've got some primary financial statements: the income statement that we've talked about, the statement of stockholders' equity that we created in some previous slides, the balance sheet, which is a listing of the assets equal the liabilities plus the stockholders' equity section. Remember that? The accounting equation. And then we have a financial statement called the statement of cash flows. So we're going to spend some time talking about these financial statements. Again, the income statement is a listing of the revenues and the expenses over a time period. If revenues are greater than expenses, we've got net income. This is the way we want it to be. Unfortunately, if revenues are less than expenses, then we've got a loss. Now, companies can't continue to be sustainable with losses year after year. The income statement compares the revenues and expenses for the current period to assess the company's ability to earn a profit from running its operations. So we're going to look at an income statement for Eagle Golf. As you see here, we see the revenues, we see the various expenses, and we end up with a net income, which means our revenues are greater than our expenses, of $1,200. This is an income statement. The stockholders' equity section helps us see the beginning of stockholders' equity plus the changes that happened during the period and the ending balance of stockholders' equity. As you remember, the stockholders' equity section comprises the common stock along with the retained earnings. Now, common stock is coming from external sources, from stockholders that have invested in the company. The retained earnings portion come from internal sources, such as net income from prior periods, minus any dividends that have been paid out. This combination of common stock and retained earnings are considered the company's value. So as we look here in the book for Eagle Golf Academy, they began the year with nothing. It was the first year of operations, so the beginning balances are zero. They issued common stock of $25,000. We would add the net income for the period, subtract out the dividends for the period to come up with an ending balance for the period. So as you see here, since this is the first month of operations, our beginning balances are all zero. We would show issuance of stock. Again, that stock came from external sources, the $25,000. Then an internal source would be the net income, which would flow into the retained earnings section. And then any dividends that were paid out reduces our retained earnings section. And therefore, we've got the combination of common stock plus the difference of the net income minus your dividends. That totals our ending balance of the stockholders' equity section. Our balance sheet is that financial statement that presents the financial position on a company at a particular date. Now, the financial position means the resources and then the claims to those resources. Resources would be the assets, and the claims to those resources are the stockholders' equity section and the liability section. One way I like to think of a balance sheet, it's a snapshot. At one particular time, you take a picture because the reality is it's always going to change. If you think about it, You may, with your own checkbooks, start the morning at 9 a.m. with $1,000 in your checkbook. But the minute you write that first check of $10, you no longer have $1,000 in it. You now have $990 in your account. So a balance sheet is at a particular moment of time because it will change after every transaction. So we're going to look at this exercise 1-2. Falcon has the following transactions with Wildcat. We're going to look at how each is going to be classified. Is it going to be in the income statement or in the balance sheet? And then we're going to talk about what kind of activity is it. So Falcon purchases the common stock of Wildcat. So Falcon is purchasing stock in another company. Well, in this case, Falcon is investing in another company. So the related account would be an investment account, and the investment account would be an asset. It's a resource. The type of activity of this transaction is an investing activity. They are investing in the current period and in the future of the company. Next, Falcon borrows from Wildcat by signing a note. Well, think about this. They are borrowing money. So the related account would be a notes payable. It's a liability. They are needing resources. So the liability would be the account notes payable. And this activity is a financing activity. It's a way in which they are receiving funds in order to conduct their business operations. Next, Wildcat pays dividends to Falcon. Well, think of this. Wildcat pays dividends to Falcon. So Falcon is receiving dividend income or dividend revenue. So that would be a revenue account, which is part of the income statement, and that is an operating activity. This is in the normal course of doing business. They're receiving revenues. Next, Falcon provides services to Wildcat. Falcon providing services would be a service revenue. This is also part of the income statement called a revenue account. And this is in the normal course of doing business, the reason they're in existence. This would be an operating activity. Next, Falcon pays interest to Wildcat upon borrowing. Well, that would be interest expense. Interest expense is part of the income statement. It's an expense in doing business. This also would be considered an operating activity. So your balance sheet for Eagle Golf shows you a list of the assets or their resources. Resources include cash, accounts receivable, supplies, equipment, and assets, for a total assets of $40,000. And then we've got the liabilities, the accounts payable, salaries payable, utilities payable, interest payable, notes payable, other liabilities of $400,000. So our total liabilities are $14,000. Our stockholders equity section is $26,000. But do you see here that the assets will always equal the liabilities plus the owner's equity? The assets of 40 equal the liabilities of 14 plus the stockholders equity of 26, which is 40,000. This always will balance. The balance sheet balances. Which of the following accounts would appear in the company's income statement? Remember, we talked an income statement would be their revenues minus the expenses. So it would be rent expense would be in the income statement. The next concept here, which relationship is reflected in the balance sheet? Well, assets are resources, and they're going to equal liabilities plus the stockholders' equity section. Again, that balance sheet's the financial position of a company on a particular point in time, in a snapshot. The company's financial position is the resources of a company, which is called the assets, will always equal the claims to those resources.